FedEx is one of those businesses that give investors insight into the rest of the economy, not just in the US, but worldwide. So I've made it a habit to follow the developments at FedEx and UPS for that matter. But in this video specifically, I'm going to dig deeper into FedEx's latest quarterly results and what the management team had to say so that we can understand what's going on with FedEx and as a result, understand what's going on with the broader worldwide economy. Let's dive in.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Right, so FedEx told investors that for its fiscal year 2025, which is completed, right? Companies are allowed to have fiscal years that are different than the calendar year, and FedEx is one of those companies that chooses to do so. They said that they delivered on their $2.2 billion cost reduction plan, which enabled them to achieve their 2-year, $4 billion target compared to the fiscal 2023 baseline. So, starting with their total costs in fiscal year 2023, they aimed to reduce those by $4 billion and they hit that target. So, they achieved that target. And unfortunately, the reason they needed to do that is because global demand for shipping has declined and FedEx strategically has lost a few contracts, most notably with the United States Post Office recently. And that comes as a result of changing consumer behavior. Ever since the economic reopening following the lockdowns during the pandemic, consumer behavior has shifted and spending has shifted more towards services and less towards physical goods. Now, as we're going to learn from FedEx throughout this conference call, I've already gone through the entire conference call transcript, and the theme was a continued shift in consumer behavior. And the tariffs are not positive to this, right? Because of tariffs, global economic trade will decrease. There will be fewer things shipped around the world, and that's negative for FedEx. And let's learn more about that here. Part of the benefit of the company's massive cost cutting plan is they're returning more capital to shareholders. They require less money to be invested into the business because the business is not expected to grow as quickly, especially in the near term. So they returned $4.3 billion in cash to shareholders. So in the fourth quarter, revenue was up 1% year over year, which is better than I was expecting. I would have thought FedEx's revenues would be down, not up year over year. And that allowed them to grow their adjusted operating income by 8%, expanding their operating margin by 60 basis points. So this is an impressive execution from the management team in planning ahead, in understanding where the economic environment was moving and planning those cost cuttings, shrinking their business, shrinking their capacity, shrinking the labor force, and thereby generating 8% operating income growth, even as the global trade environment worsened and consumer behavior shifted. They still generated excellent profit expansion. So kudos to the management team on this achievement. FedEx saying that business to business volumes remained pressured, which affected both FedEx Corporation and FedEx Freight results. FedEx Freight specifically and their ability to protect profitability with an operating margin of 21% in the fourth quarter. That's a solid operating profit margin for a business with such high levels of capital intensity. FedEx, it's a capital intensive business. You've heard me talk about some of the asset light businesses. FedEx is not one of those. Very capital intensive, right? It needs warehouses, planes, trucks, all of that very expensive. Maintenance is expensive. The purchases and building of those materials and equipment is expensive. And so to generate an operating margin of 21% on that kind of a business is an impressive accomplishment. So I mentioned that management had done a good job planning ahead. They reduced their capacity from their Asia to Americas lane by more than 35% in May compared to April. And of course, in April is when those tariffs were announced by President Donald Trump, the increases in tariffs. And of course, that had a negative impact on demand. Businesses that are importing goods are now less interested in importing those goods because they have to pay a higher price. And if they have to pay a higher price, they are concerned with their own profit margins. They are not sure that they can raise prices on their customers to recoup their own higher cost. And so instead of trying to take that chance of just saying, all right, we'll just buy the same amount of things that we were going to buy, we'll pay the higher price, and then we'll raise our prices on our customers. Businesses are not confident that they can sell their products when they raise their prices on customers. And so instead of trying to do that, they just lowered their orders. They said, let's wait and see how these things develop, and then we'll make a decision later on. But we don't want to just pay these higher costs and then just expect that our customers will pay us for those higher costs. FedEx did report some good news in that they exited May with a net capacity of 20% versus April. And overall, they talked about how May was better than April. So, April, of course, was when those tariffs were initially announced, and the reaction from businesses and stock market participants and investors was just like to paralyze activity. It shrunk and people just waited, canceled orders, paused orders, didn't make any new orders. There was a huge decline in economic activity. And of course, that chaos caused the president to pause those tariffs. And then in May, economic activity returned to normal, or not normal, but returned to better levels than they were in April. So they began introducing some network changes in Asia, allowing them to consolidate from multiple points into a centralized gateway. They also recently added a direct flight from Singapore to the US, enabling them to more efficiently capture the increased demand out of Southeast Asia. And I suspect more of this will happen. As you might already know, I follow a couple of hundred companies. Many of them are importers, and many of the importers that I reviewed, including Amazon, Walmart, Target, Costco, Apple, and others, all talked about a similar strategy in that they will be importing fewer things from China and importing more things from Southeast Asia. So instead of manufacturing and importing from China, they will be manufacturing and importing from other countries in Southeast Asia that have lower tariffs. So FedEx reiterating that, providing another point of evidence that they are responding to that increased demand from countries outside of China, but in and around Southeast Asia, as American businesses that are importing are not really, I haven't seen this yet, they're not really increasing manufacturing in the US. I haven't seen that with any company of those roughly 200 to 300 companies that I'm following. Almost zero have noted that they're going to increase manufacturing in the US. What they have said is they're going to reduce their reliance on importing products from China and increase the imports from other countries and in and around Southeast Asia, from India, from other parts of the world, but still not from and not manufacturing in the United States because those costs are still way more prohibitive than importing goods from outside the United States. So, really interesting information here from the FedEx management team, giving us insights into their latest developments. And by the way, I'm reading from the company's Q4 2025 earnings call transcript. This highlighted document is available for all channel members. You can join for less than $5 a month. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.